Good evening and welcome to our second webinar of the Accounting and Finance Show 2020 series. Today we have a panel discussion which will be exploring flattening another curve, managing the liquidity crisis and leveling the cash flow gap. This panel discussion will be moderated by AlokAggarwal, who's the director at Crowe, and he will introduce you to our speakers and will lead us in a very interesting discussion this evening. Can I now invite all of our panelists and our moderator to turn on their webcams and mics and join us for the discussion. While our speakers are getting ready, just a note for all of our webinar attendees that you can ask questions throughout the discussion. Please use the Q&A box in your control panel to ask questions throughout. Alok will do his best to get round to the questions at the end of the discussion. Okay, so without further ado, over to you, Alok.
Thank you, Rion, for the introduction, and welcome everyone to the event, my panelists, and of course, the entire audience. It's great to have all of you here on this excellent topic, which is flattening another curve, managing the liquidity crisis, and leveling the cash flow gap. And in interest of time, we would love to, have an interactive session and ask my panelists to be brief, and of course we invite questions from the audience, and the questions, as Rion indicated, can be given in the Q&A box, and we will try to answer them as many as possible, keeping the time constraints in view. So we are all aware that coronavirus pandemic has left the corporate sector scrambling for cash. So it's really tough for the robust financial system so far has been able to provide the short-term liquidity funding primarily through the revolving lines of credit, which were available previously to majority of the firms. But now, will this be enough in light of the coronavirus crisis? And revolvers used to bridge the temporary cash shortfalls previously, and now we are all aware about the associated issues, especially when we know that the corporate balance sheets are already highly leveraged. And pandemic is so severe, and there is so severe external shock, which affects entirely all the players in a similar way across the world. And so at this webinar, we will try to discuss as to how the interventions could be explored, and how do we leverage the resources, the scarce resources and skills in the financial markets from which the economy will emerge less damaged as the shock subsides and markets grapple to return to normal. So without further ado, I get into the mode straight away to Nilofer. And Nilofer is the head of risk compliance and internal audit at Amazon. And on my other panelists, Noman Asif is our chief financial officer at Beth.com. And then our third panelist is Dunya. She's CFO at Bakelite Media. All are distinguished panelists with an excellent track record. So all of us, including myself, we will be delighted to add value. And myself, I am director at Crowe. We are 8th largest accounting and auditing firm in the world, and I'm leading the financial services practice at Crowe UAE. So over to Nilofer. Nilofer, as we explore how the corporate balance sheets are already highly leveraged, as I've said, and there is an intense struggle to obtain financing from the existing loan creditors in the current climate. So what are the financing challenges these larger companies will face? What do you think?
Well, as we are all aware that these corporate balance sheets are already highly leveraged, and it is evident that the leverage loans to these corporate companies are funded primarily by the non-bank institutional investors, with majority of the cash raised by the issuers of collateralized loan obligations, which is called CLOs, to the leverage loans. So normally these leverage loans are provided because they offer a very high interest rate, and loans to the companies that are relatively highly leveraged, consequently offer higher interest rates to reflect the added risk. So the CLO structures have been popular over the past few years and have evolved over these years at their core, but they are all designed to protect investors at the senior end of their capital hierarchy, because the CLOs normally they are comprised of or I can say they are mainly owned by the banks or the insurance companies, which favor income producing investments. So when we talk about these CLOs, they are already, they have a threshold. So what I have researched that it's like around 7.5% of their whole portfolio in the CCC loan. They are limited to investing only to that percentage, and they are already over on that. So CLO managers, they have already entered the pandemic crisis. Before this pandemic is started, by the way, and the portfolios are overweighted with the loans. So this, I can say, is a crisis which is hiding around the corner, and people might not be very, very aware of that, but this is hiding around the corner. Given the covenant constraints and current market conditions, it is pretty clear that CLOs will be unable or at least unwilling to extend any additional capital to the most leveraged borrowers at the moment. So I was reading some news like recently, so it is worth noting that very recently, two recent debt restructuring which happened, Deluxe in USA, Deluxe Entertainment and Acosta, CLOs declined to even participate proportionately. So, this is the first challenge that I guess these corporate balance sheets who are highly leveraged, they are going to face. And the second one is, given that their bank credit lines are already full, the effective closure of the main sources of liquidity for lower rated companies leaves only one plausible private sector source for these companies. When I say private sectors, these could be private capital investors, specifically distressed debt funds, private equity or private debt funds, or even hedge funds. But these investors, they do have plenty of money available at the moment, but in the current circumstances, especially with the debt of many highly leveraged companies which are trading well below par, they are not doing good on the stock market. So these investment by these players will likely entail some form of capital restructuring. We all know that they might go for capital restructuring. And this really is a complex process which require extensive due diligence and involve negotiations among many parties. So when we talk about the timings, investors may not be able to provide them with very quick liquidity, especially to meet the timing of these borrowers' need. So I guess these are the two financing, from my point of view, these are the two main financing challenges that these larger companies are facing. And at the same time, because of the operating challenges, because these financing companies, they do have to repay their loans. But then at the moment, because of the operating financial situation, operating situations, especially because they have a substantial decline in sales or even a complete suspension of operations, these companies are already facing cash flow insolvency threats. So, they don't have any more sales volume. The sales have dropped. And then obviously there are fixed and variable costs that they need to meet, and at the same time there are financing costs that they have to bear because of the paying of these loans. So they are already at a liquidity crisis, and they have to think of ways of managing these cash flow gaps.
Yeah, Nilofer, yes, I agree that these are the very serious issues which need to be tackled both at length and in breadth as well. And corporates and everyone involved in the space have to think through as to how they can be addressed suitably. And on top of it, we understand that the global corporate sector had gone into the pandemic with unprecedented levels of high leverage already. So now that was possibly because of the low interest global environment which we had, and especially after the 2007-8 global financial crisis, which made easier for the companies, to borrow. And according to different reports by Standard & Poor and various rating agencies, the global debt has gone up from 15% from 2008 to around 93% of the global GDP. This is as per the S&P estimates. So now we can imagine that almost $6 trillion ballpark sits on the balance sheets of the companies that are highly leveraged. So now, having said that, borrowers have been artificially able to inflate their earnings for loan tests using liberal EBITDA add-backs. So that has been the case. Now, having said that, it makes very difficult, for the companies to seek financing options. And there are various financing options which are available in the market. So, I mean, Nilofer, what are the financing options that you recommend to these highly leveraged companies?
Yeah, I mean, this is a very tough time for these companies to manage, their cash flows and to get more financing from the market. So some of the most easy form I can say that I can think of is, I mean, the first one is equity to deleverage. Although we have seen corrections and volatility on the public markets, but valuations are still high on the historical basis. And
Yep.
the same is true for valuation multiples for privately held companies. So if they act now, I guess businesses of all sizes and across all segments, we can use these strong valuations to lower debt and solidify their corporate structure. So here it's not only confined to the big corporate companies, but also
Yeah.
the small or medium-sized entities. They can also go for IPOs, and they can also, I mean, get their balance sheet revalued. So this is one of the things that the companies might think of. Another one that, I mean, we can also talk about is mergers and acquisitions. So when we say merger and acquisition, so full-scale merger and acquisition are the most transformational equity transactions. But the biggest challenge here for the acquirer at this stage is creating shareholder value for the deal.
Yeah.
But then there are also significant challenges for the selling company, and because they have to find an ideal buyer to manage the operations during.
You're right, Nilofer, on that. And on top of it, there are various options which the corporates can look at, right from variety of government initiatives the governments have taken in globally, especially the stimulus packages and various other initiatives, including options like asset finance or even term loans, or to put in another manner, inventory finance even, or revolving credit, which we have discussed. And of course, the ODs, investor finance, and of course equity or alternative or mezzanine finance options. So there are a host of options available, but again, it is that they need to be very cautious, especially considering the cost and of course their own risk appetite, especially in light of
Alok, I think like now it is a very high time that the businesses, they start to look at their models as well. I mean, there could be a lot of areas they can look at, like divestitures, which is like a strong growth has led many companies over the last decade into new areas of operation. I mean,
That's
if that
right.
is being on the company, then selling the non-core operation as a means to deleverage can strategically be beneficial for them as well. So I mean,
That's right.
Yeah. So
I mean, there are a host of the financing options, which I said earlier, and they will be highly influenced by a variety of things, which we are aware, especially the optimal debt equity mix, or even the robustness of the balance sheet, or even the working capital or the cash cycles, or the balance sheet capability to deliver, even the risk profile and ability to mitigate the risk going forward, and availability and pricing of financing options, which will play a key role, as I said, and adaptability, affordability, and of course, the time frame or the urgency of financing. So, I mean, there are a host of factors which we can go into, but, on a very interesting note, I would like to pose the next question to Numan. Talk about flattening another curve, managing the liquidity crisis and leveling the cash flow gaps. So, I mean, could you just highlight as to what are these cash flow gaps, and in your experience, what can the companies do to reduce or rather zero out the cash flow gaps.
Cash flow gaps. So thank you, Alok, and I hope everybody and along with the attendees are keeping well and safe. So one thing, I mean, before I sort of directly divulged into your question, I want to drive home the actual cash flow and how important it is. I'm pretty sure all the attendees do really understand the importance, but yeah, I mean, I come from a family of accountants, so the discussion over dinner is somewhat, let's just say, becomes quite interesting. And one thing that my father sort of told me at one point is that revenue is vanity, profit is sanity, and cash flow is reality. So, which basically sort of drives home the point that without cash flow, without cash, you really can't possibly function. Or even though you have a great top line, you may not be able to still operate the business just because of the top line, or even the profitability. Is the one thing that drives the company forward is definitely cash flows. And these cash flow gaps are basic gaps between when you're selling to your customer versus when do you pay your suppliers, and when these customers do actually pay you back. So that gap causes the cash flow gaps, and that's what it's all about. And how do you bridge that gap is quite important. And this obviously, if you have good cash reserves, then obviously that quite really helps. But at the same time, considering how the economy is moving, considering what sort of circumstances we are currently undergoing, it's a very good time to actually sit down with your stakeholders. So sitting down with your stakeholders, from suppliers, from customers, and understand or agree or revisit your terms of payment. Because to bridge this gap, that's one thing that you really have to do, is to keep everybody on board, or bring everybody on board, have that communication. So that's one of the key areas that can help bridge that gap. At the same time, you can offer discounts to your customers. So not only you're helping yourself, but you're also helping the customer get a decent value out of an early payment. You can always reach out to your bank and think about factoring of your receivables. So if you have receivables outstanding and you know that it is going to be a challenge, then why don't you just go and approach and try and factor those receivables? And as you, at the same time, you mentioned that you can always look into inventory financing. But at the same time, you really have to revisit your business, understand what is absolutely necessary versus what you can delay. I mean, it can really, you can really go back and do some sort of right sizing within your organization, look into efficiencies, how you can bring those efficiencies back. But at the same time, when you're talking about receivables, it's not just, I mean, this is considering the circumstances. This is not just the time of looking up to your receivables team and saying, oh, why aren't you guys getting me money? But in fact, it should be a priority for everyone in the organization. So even if, and I know cases where CEOs are directly calling to collect money or request their customers to, if they can release their funds. So it's quite important that everybody is on board. All stakeholders understand why this is important for us. And at the same time, you can sort of revisit your model as well. Why, if you feel that you have products which have higher cash margins, so if you have higher profitability margins, why don't you focus on those products? Because that will help you generate more funds, or that will be the right application of your existing working capital, because you can earn a better value on that return. So these are some of the ways you can sort of bridge that gap. And at the same time, you continue to make sure that you are planning for the best things.
Numan, what are your thoughts on cash management and liquidity planning?
I mean, for cash management and planning, it's very important that you really understand your ratios. And some of the basic ratios could be your cash ratio, which is your liquid assets divided by total liabilities, and that's a very typical ratio you can sort of review. But during the current circumstances, you can obviously go and create your cash flow forecasting. And the cash flow forecasting could be on a weekly basis, on a monthly basis, but this is something that probably for you as an organization is important for you to understand what sort of a time period is required for your cash planning. I mean, I would suggest going to 3 months or 6 months would be the key, because as far you go into the future, things become a little bit more blur. But if you can plan out the next 3 months and continue to plan those going forward, that can really help you in terms of your cash management. And you can always work on your cash flow gaps as well, and you kind of work it out yourself, and it's pretty easy. You can just take your receivable outstanding days and take into account your inventory days, and just take away the trade payables from it. So you will find out what sort of gap do you have.
Exactly, that's right, Numan. And also the businesses broadly need to understand the objectives, which include understanding and monitoring the liquidity impact, and of course, understanding the impact on working capital and profitability. And of course, if they require an additional funding, then they can always, look at the various options. And on that note, I mean, even having like an extended cash forecast, like say, for example, for 13 to 14 weeks in light of the pandemic would be helpful. And the real-time updation of such rolling forecasts, because things are changing at the drop of a hat with every passing day. So it becomes very critical. And I would also like to emphasize one more thing to whatever you have said, is the real-time scenario planning. Because when we visualize against different scenarios, then of course we can take a call in terms of how the gap could be better abridged in light of the continuous situation which is evolving, and keeping the stakeholders involved, keeping the governance, communication, and everything aligned. And we need to also be mindful of the fact that we are into new normal, where there are new ways of working. So many suppliers and many employees and everyone, they are operating from home, or they are operating in a disruptive environment. So all those things, wherever applicable, can also be factored in. So, I mean, that's not all on the cash flow gap, but yes, I'm seeing some questions on that. So we will definitely address. It's an interesting topic. And now, having said all this, I would like to ask Dunya that analyzing the structural limits on lenders and the likelihood of extending any additional capital to even the most leveraged borrowers. So what are your thoughts on that, Dunya?
Yeah, thank you, Alok. First of all, I think, being aware, if you're a company that's highly leveraged, you probably will not be able to avail a loan that quickly. It's very lengthy process with financial institutions, reaching out to external parties, even looking at availing new capital through selling business units that through the exercise, as Norman already explained, understanding where's the core business versus the non-core. These are all processes that can take quite a bit of time. And right now, companies have seen massive reductions in just a very short period of time. So I think the most easiest way at this stage for companies will be to reach out to existing shareholders. Often these loans from existing shareholders come at a higher interest rate, but the conversation with shareholders is generally much easier. Why? Because they know the leadership team, they know the seniors in the company, they They are familiar with the business model. They already are vested in the company. They already have that vested interest in the company. So they're the last people who want to see the company default and go out of business. So reaching out to existing shareholders is, in my opinion, for highly leveraged companies, the first step they should take. Offer attractive loan structures to existing shareholders to bridge the next couple of months or how long this is going to last. But also on that, adding on, I think having internally better structures in place to continue to monitor. I mean, these loans will be expensive. So having rolling cash flow, having continuous cash flow forecasting, even in longer periods, run scenarios, worst case scenarios, really think about what could be the worst thing happening to this company. And of course, we all want to be optimistic, and we should be optimistic, but as finance professionals, we have to be risk averse. We have to really think what is the worst thing that can happen. And that should be the loan structure we should also discuss with our shareholders. So having that at hand and understanding what would happen if the next 6 months we actually have zero sales, and then only we slowly see the recovery. Planning these scenarios, thinking about these scenarios, and then have this open conversation with the shareholders to actually know that the cash can be made available even if those events are triggered, which we hope obviously they will not. But
yeah, that's very well articulated. If I may ask, I mean, because all that will come at a high cost, which businesses will be finding difficult to afford at this point in time. So how do we address that?
So I think looking at cost, the company, the first step for the company is to get together and to understand and to be transparent across the organization that there's an issue and that the company is highly leveraged and that there is a cash need that needs to be addressed immediately. There are different ways on how you can keep employees motivated, but the most important thing right now and the biggest asset a company has is its employees. So I think in that process, what's most important is get your team involved, get all the stakeholders involved, be transparent without making them scared, but still make them part of this process, help them to find a solution. And there are a lot of ways, what I've seen actually, there are employees that would be open to take unpaid leave now.
Yeah.
Why? Because kids are at home, they are unable to actually manage the working from home with the kids, or even a lot of employees are open to explore working part-time. Things that, especially in this region, we haven't really seen much. Another very interesting option is for companies to look at actually making employees shareholders. So looking at, instead of having 100% salary, shift some of that into equity-based payments, wherein every employee, even the ones that execute, not just management, because a lot of times we see these programs only available to senior managers and the leadership team, to make that available company-wide, make everyone a shareholder of the company, and make
That's an interesting thought, Dunya. But the key point here is that, businesses, many of them, they want to get themselves going. So that is an important thing, while they would need to, have a fine balancing act between what is currently doable and what is not. But definitely these were some of the very, very interesting thoughts. And what that requires basically is a very effective crisis management, strategy on part of the company as to how we can manage the crisis, in a manner that the firm comes out stronger, there are certain fixed things which will not change, and then there are certain variables. So the company, the board, and the relevant management and the stakeholders need to take care of how they address this situation in light of an effective crisis management situation, instead of just being reactive. I mean, they need to have a holistic view, whether they may be one country organization or a global organization, where things are getting impacted, as to how they can be, addressed so that they are resilient and they can, take care of quick wins in this kind of situation, which will keep themselves motivated. So over to, Nilofer now for the next question. So what are the plausible solutions, especially for the lower rate companies, or the private capital investors? And here I'm talking about the short term or the medium term solutions for the mid-size or small size companies to come out of this crisis. Nilofer.
Yeah, thanks, Alok. In every business, all departments are working full steam to stabilize the business. To understand the consequences and to prepare for an economic downturn. So playing a central role, I guess the finance and treasury function should be monitoring and actively steering a company cash and liquidity situation to prepare for the potential challenges. Some of the actions that the companies might take, they can secure global funding daily with the daily cash visibility of the global cash position. So when I say global cash position, it is for the whole group rather than thinking about each company individually. So they can identify and release the trapped cash within the group structure for basically efficient use within the group. They can talk to banks to secure and extend credit lines. They can use the group's leverage and the ancillary businesses they allocate to banks strategically. So, tracking the working capital KPIs closely, although it's not very easy at the moment, because obviously every businesses, they are facing difficulty with recovering their cash from the customers and obviously paying back to the suppliers. So this is basically, but obviously the company has to at least think about the practical and realistic measures. So at the same time, like as you mentioned before, thinking about or looking at the government's initiatives which they have taken for helping out these businesses at this point of time. Monitoring, analyzing the internal credit risk of the existing cash pool structures, and I think defining limits for the cash pool liabilities can help also.
That's interesting. That's an interesting angle, Nilofer. Now, talking about from one of the things which you said is about the possible government intervention measures. So here I would like Dunia to throw some light on that, because we have been seeing governments are coming out with lots of stimulus packages and stuff like that. So, we would like to have your views as to how we should visualize them and take benefit.
Thank you, Alok. I think Dubai and international global governments have been very quickly responding to this crisis. I think, and I can say for myself, being in this region, I'm very impressed and pleased with how the government has come out quickly with regulations, how they've helped not just companies, but also individuals to help them restructure loans, get delays or even reductions or free rent and on leasehold, defining new regulations around employment and trade. So I think the governments here in this region have been really reactive and proactive at managing this crisis. Now, what we need to bear in mind when we think about government, unlike in Europe where I'm from, where you have a corporate and individual income tax, here the government fully relies on the value-added tax, which also is going to be impacted because the consumer sentiment and spending has significantly dropped due to the working from home, due to the restrictions on the movement. So the government, like companies, is also suffering in their own income. And though the Dubai and this region has done really great at managing it, they have only very limited ability to actually support businesses. One thing, and that's, what we are seeing now in this region, and I think that's more, again, company and government side, a huge risk is people leaving because of layoffs. Now, how can the government make sure that they also preserve their own income? One of the ideas that could be explored by the government, and they are doing already a lot on that side, is actually giving seed money to investors, to groups or individuals that have a great business idea, to build a panel with VCs and to actually allow these individuals and groups to present their business idea to then get that funding. So like that, you can stimulate small businesses and also prevent more people leaving this region, which will have a further impact on spending, on sentiment, and of course on the company's bottom line and cash.
Brilliant. That was nice. And now, Noman, that brings me to an interesting question that is it a good time for companies to think of restructuring? What do you say?
Well, it's certainly, I mean, we need to look at the company requirements, and if they feel that, you know, considering how the economy is moving, if they don't see the growth they had initially planned, if they don't see margins that they were initially planning, if those are not coming in, then possibly it is a good time to restructure. So if you don't see revenue growth in the near future, or if you don't see profitability going increasing in the near future, then possibly it's a good time to restructure. And at the same time, if you, as we have already spoken about, if you are over leveraged, so at this point in time, you need to find ways to get more cash in the organization. So the best, one of the ways you can manage that is also by restructuring, realigning, and refocusing on some of the core areas, as Dunya initially said, that we need to go back and see what is core for us, what will generate value. So bringing back that laser eye focus is important. And also at the same time, you know, if you are in an industry which has possibly really taken the worst hit, it may be time that you reconfigure your business towards different industries, or refocusing or trying to shape up your product for which is readily acceptable by other industries. Right. So again, that's part of the restructuring thoughts that should really come into your way. And then, I mean, even now there are restrictions coming in terms of mobility of labor, and in terms of how what you can do and what you cannot do. So you really, in all cases, even while you're not thinking of restructuring, you are already doing some sort of realignment, restructure. No,
that's absolutely well said. I mean, the companies need to be mindful of their restructuring strategy, and if need be, then they can take a call on that in a calculated or calibrated manner. So Dunya, a question to you, how transparent do you think companies should be about their financial situation? It's a very tough call for them. So any thoughts around that?
I think if you ask CEOs, they mostly will answer, don't be so transparent. I think as a CFO, I actually think the other way around. I think you should be transparent. Your employees are part of your organization. They are part of your values. They are part of you. And I think if you want to make sure that they remain motivated, if they continue to deliver results, if they don't burn out, they buy into what you're doing, even if you have to resort to layoffs, which no one wants, but at times you have to. Transparency is the key. And I think, you know, by keeping information away, you're just unnecessarily making people nervous. And, you know, it's like these closed meetings. People walk by, they see the seniors all in the room having a closed meeting, even though now we're all in the virtual world. But here, maybe they don't hear from their seniors often, or the seniors don't interact with them regularly enough, or they are not there regular for them. That already in itself creates fear. And fear is the worst thing that you can do to your employee, to the performance, because right now the one thing that you need is performance. You know, either in innovation or people helping you to find better solutions, come forward. and it's our teams actually that have the answers, not us.
Absolutely.
Like, I always feel if I have a problem, I go to my team to discuss it and not myself. I mean, here they are in touch with every single step. They are in touch with the suppliers. They're in touch with the customers on every stage. So they actually are the best people.
Absolutely, Dunya. I mean, the management, the board, they need to have a pulse of the organization as to what direction it is heading, and what are the the external touch points, what are the internal touch points, and they should be mindful of the fact that the organization needs to recalibrate its approach in light of fulfilling its objectives in view of the change situation, so that they can continue as a going concern. And so, in that light, the going concern assessment also becomes very critical, for the organization. And apart from that, on a different note, but yes, everybody in the audience also would agree, and you all will agree, that integrity, ethics, these are the things which should never be compromised, be it pandemic or not, because ultimately the future lies in conducting the business, in conducting the operations with integrity, and where the senior management, where the board and all the stakeholders are mindful of ethics at all the times. And that is one point I would like to emphasize. And when everyone talked about employees, I mean, empathy, compassion, all these things, should also be there. I know, these things may not be very relevant in a normal situation, but in a COVID-like situation, when we are grappling with so many issues, especially the liquidity crisis and all that, we do not want the additional issues to camouflage the real issues. So I think that brings us to, we have around 10 questions. So we can utilize the rest of the time, in taking them up. So I think I'll just have a quick read, and then everyone can answer very briefly so that we can address, we have the rest of the time available with us very quickly. So over to Noman. How useful have the retained earnings of the companies been to pay the debts?
Well, it depends how much retained earning you really had. So, of course, it would be your sort of a cash reserve, and if that has been your cash reserve, and if you had a sufficient amount, then that's great. But what we have seen is that companies are actually, a lot of companies are actually leveraged, but at the same time, do you have the cash, the real cash? So you may have the retained earnings.
What kind of cash flows, if we are talking about very briefly? That's another question.
What kind of cash flows? So, I mean, what kind of cash flows? What would I mean?
Somebody would like to understand, when we are talking about cash flows, then what kind of cash flows the organizations need to be mindful of?
Of course, I mean, from a cash flow perspective, you really have to understand your customer outstanding days. So you need to make sure that you have funds coming in, and at the same time, you need to understand what do you owe to your suppliers, and how your working capital is moving. So that will definitely help you.
Right. So if a customer is facing the cash gap, I mean, and the organization can't propose an early settlement discount to the customer. So what is the suggestion that you would like to give?
If you cannot offer the discount, you need to really figure out what are your next best options. So if you are able to secure some loan from outside, you can always go ahead and secure that. But considering the circumstances right now, it is possibly very difficult for you to go out there and request for a loan, because you do have the stimuli from the governments, which will help you delay, or if you do apply for the deferred payment options, you can delay some of those payments, and that can really help you in managing that cash.
I have another question.
Yeah.
This is about the payments, to the suppliers. How about payments from the customers? What is an innovative method? That's another question.
To bring
Today's situation is different. So the supplier needs money like we want it from the customers. So what could be an innovative approach rather than the approaches which we have discussed about? Any thoughts?
I mean, the best thing, I would go back to Dunia's point of communication, because it's really important that you bring your stakeholders with you so that they really understand. Because at some point, for you are a stakeholder, for the supplier, and from a customer perspective, you are the supplier. So you have to bring your stakeholders on board and let them understand what cash challenges you are facing. And based on those, you obviously have to, right now, I think what some of the gaps do really occur is because of that communication. We switch off all our communication channels to avoid those calls. But
so
in fact,
in addition, we need to be, more proactive than being reactive, a point which we discussed, earlier as well. So there is another interesting question as to how one can be more proactive.
How one can be
stronger cash flows. That's a question.
Well, the scenario planning is a great tool of being proactive. Cash flow forecasting is a great tool to be proactive. If you understand how your cash flow is going to move in the next few weeks, I mean, that's great, because at least you are already working on it. So you can already pick up that phone call with your supplier and tell him that I know I owe you this amount of money in the next 20 days, but is it possible I can delay it? So rather than the supplier calling you on the 31st day saying, where is my money? You tell them that, look, I am facing this challenge and I need that spare time to get you the funds. So being proactive, being transparent is key to managing these relationships.
Very well summed up. So over to Dunya. What do you think that existing shareholders will be unhappy if the new shares are issued, because then it will dilute their powers or ownership on the company? That's another point.
Certainly they would be, but if new shares are issued, then that would mean a new shareholder to join. So I think here what you're looking at is either you're going into a round at probably the past valuation with certain discounts being offered to the existing shareholder to do a contribution based on the existing shareholding. Or, as I said, you reach out to those shareholders for a loan, which is even a much quicker process because you don't have to have so many legal documents. So you could, I think the first step, get a bridge loan. This will buy you more time, to at least bridge the next 3 to 6 months. So that gives you sufficient time to also then work on a fundraising and fundraising takes minimum 6 months to 9 months to go through with lawyers and everything involved. But yes, of course, you can explore shareholders contributing, but here every shareholder, every board member has to agree, and that's often also a bit difficult to achieve.
Right. And secondly, how do you foresee the increase in VAT in other Middle Eastern countries like Saudi Arabia? And what do you think this increase in VAT in Saudi Arabia is going to impact the cash, the forecasting?
Let me get my crystal ball. Frankly, I don't know if in the UAE they would be introducing a higher VAT as Saudi did, because I think it's generally a burden to the consumer, and the consumers are already burdened with lower salaries. With less money actually to spend, and you will not stimulate spending by increasing at this stage. And I don't think the sentiments I've seen with the UAE government that this is where they want to go down and the route they want to go down with. I think it might be more likely for them to introduce corporate income tax in the next 18 months. Why? Because these were already projects that were in the pipeline. Though not officially or on open channels talked about, that there were indications that corporate tax might come to the region sooner or later. However, if that's happening, the government also indicated it's gonna phase out all the big fees, government fees, you know, which is kind of, if you think about it, if you're a small organization, you pay the same amount of fees as a large organization, wherein as an organization, you're more leveraged, you have lower profits. So actually introducing corporate income tax will be a fair approach on how the government earns their income from the businesses, and could actually help businesses again to drive forward. And yeah, I think that could be a viable solution.
Right. So let's see that the time will predict. Now over to Nilofer for another interesting question. What are your thoughts if you know, the vendors do not cooperate, because the terms have to be renegotiated, especially in the COVID times? So what to do? I mean, how the companies can handle this situation?
I mean, like vendors are also one of the stakeholders. So I guess if we have a long, the businesses have long relationships with these vendors, they should cooperate. And if they are not cooperating at this point of time, obviously then looking at some of the other initiatives like government is offering, or looking at your existing bank credit terms. I mean, those are some of the key things that you can look at to repay back to your vendors. But then again, I mean, if these vendors do not cooperate at this stage, obviously those might not be your long-term vendors then. So I mean,
if this is about the vendors, Nilofer, how about suppliers?
So the same applies for the suppliers as well. I mean, if they obviously they are your suppliers, you have a long-term relationships with them, and if they are not cooperating, they are one of your stakeholders. So obviously, then you have to go out and look at your look at what other credit terms you can get from your banks. You can talk to them to secure and extend your credit lines. Talk to the group if you are part of a group. Talk to your group to see if they have the group's leverage and the ancillary business that you can allocate to the banks strategically. I mean, these are some of the things that you can think of. And then to avoid the going concern problem, obviously, if you are paying back to suppliers and you are not getting money from your customers, you will end up having going concerns issues. So then that also requires the management to prepare for a going concern assessment. So I guess these are
that's right. So does this throw up opportunities for the financial firms?
When you say financial
houses or the big financial institutions, this particular liquidity crisis?
Obviously, because what these financial firms or I mean these private investors, what they already have, as I mentioned earlier, they already have money in their hand. But it's just about how much risk they want to take with these leveraged companies, or even the small size companies, because obviously for a small size companies, they will always look for their going concern assessment, like whether they are going to invest in such companies, and if there is a bankruptcy, they will lose everything then. So these companies, these private investors, they have a very good opportunity here, especially they can always have high risk, a high interest rate against the risk that they will be carrying.
Right. So over to Dunya. How can companies resort to, if they have to resort to layoffs, which is, a difficult call for the companies, so how they can reduce their cost basis? I mean, any passing thoughts on that?
Yeah, I mean,
right away to layoff.
If the company does eventually have to resort to layoffs, I think there are a couple of considerations that should be taken care of. First is that oftentimes companies lay off executing staff before management. Why? Because management staff is more expensive to be rehired. They are, you know, more difficult to be attracted to the company, and so you know, laying off more the lower tiers of the teams seems to be at first a great solution. However, who's left to do the job are the managers, and now those managers find themselves actually doing the job because they don't have a team to manage, or a very limited team to manage, which is sort of also not the best use of their time and their knowledge and experience. And you're basically with that slowing down innovation. So what I'm trying to say is, first of all, you need to have a clear strategy on what are the team members really contributing in your organization, and how you can slim down or you know, shift employees to other regions, lower cost-based regions. Another thing then to consider, you know, if the person is gone, is it now going to be a consultant who's going to take over? Because if that's the case, and you're shifting just the cost from an employee to a consultant, you're better off just keeping the employee. And the last thing, you know, when companies go through layoffs, again, it creates fear, and even managers fear of their jobs. You know, I think if let's be all honest, we all
That's
have.
right. Dunya, there's a question for you. How we can manage our receivables, especially those are already past due?
How to manage receivables? I think first step is to have a regular meeting. I think it's such a simple thing, but I can tell you most companies fail on doing it.
Or any special category of expenses that can be addressed at cash flow forecast?
Let me maybe just finish on the receivables, because there's one thing that I would like to share with everyone. What I found very useful is to have legal and customer care in these meetings. A lot of times receivable meetings are meetings just between finance and sales. They shouldn't be. Your sales, your customer care know the customer, they know the pain points, they know the technical issues. Have them in those meetings, because they can bring color to the conversation. And legal can actually also help you to look at other possible ways on how you can chase your money, right? And on top of it, get tech involved. How can you automate your payment process? Because we are in an environment. And these are all ways on how you can bring in money much quicker.
Wonderful. So thank you so much, Dunya, on that. Any parting comments, Noman, on the cash flow? So there's a lot of questions on cash flow. Noman, I think you are muted. No issues. Then, okay, Nilofer, any parting thoughts?
I think everyone is facing these cash flow issues as I explained before. So when we talk about the terms we have with our suppliers and we have with our customers, I guess we need to revisit those terms. We need to work with them very closely, get some creative ideas about how can we basically.
Thank you, Nilofer, for that. Yeah, thank you, Nilofer. Thank you, Noman. Thank you, Dunya, and the entire audience. You know, for sharing your thoughts, the panelists, and for audience for being such an interactive audience. We had wonderful questions, and thank you so very much, you know, for having enriched this discussion. And I hope we have been able to add value on this critical topic, the webinar, which was all about managing the liquidity crisis and leveling the cash flow gap. And I hope the audience leaves with some thoughts at the end of the day as to how to progress the matters in a more pragmatic manner in light of the situation. In the meanwhile, I extend my best wishes and prayers. So let's all continue to pray that we all, you know, come out of this situation much more stronger. Until then, stay safe. Thank you, everyone. And I give the mic back to Rion. Thank you.
Thank you.
Thank you very much, Alok, for leading that very insightful session. And thank you to all of our panelists for joining us here today. That is the end of the second webinar of the series. The webinar will be accessible via our website for on-demand viewing within the next 24 hours. If you do have any questions, please feel free to get in touch with us via our website. We have our next webinar at 4 p.m. on Wednesday, the 17th of June, which will look at creating a risk management framework. So thank you on behalf of the Accounting and Finance Show to all of our panelists and our moderator for joining us and for taking the time out of your busy schedules. And to thank you very much to all of our audience members for tuning in. Hopefully you can join us again on the 17th of June. So to everybody, enjoy the rest of your evening. Bye-bye.
Thank you, everyone.
Thank you. Bye.
Thank you. Bye-bye.
Thank you.